So a couple things you all need to bookmark. ffl-go.com is where you're going to be able to pretty much have access to all of our main carriers. There's going to be some ancillary carriers that aren't going to be on this list, like Prosperity and what else isn't on here? Aetna. Those are kind of the main two that aren't on this list. But you can pretty much get to just about anything you need to from this area with quotes, underwriting guides, e-apps, contacts, et cetera, et cetera. I'm sure some of you all have had some issues with Americo and getting to the quote and getting to the e-app through FFL -Go. At least I have. So there's a couple different options, some backup options. One is you can go through Velocity, fflvelocity.com, and you're going to have Hamadi put a quote tool in there for you. But then also what I typically do is I just do quote.americo.com. And that gives you access to all the products that they have. Eagle Premier series, that is our main final expense product. That's our go-to. HMS Plus 100, that is our mortgage protection minus any accidental death benefits that are tied in. The HMS Plus adds in, I think it is 25% of accidental death on top of that term policy. And then the HMS Plus CBO, that's the cash back option. So that's the mortgage protection plan that gives you the cash back. So once you start to go into mortgage protection, these are going to be your main three that you're gonna look at. Try to write HMS Plus CBO and HMS Plus 125 because they're better products. We get paid more, all that good stuff. I haven't written an Advantage Whole Life, which you see right above the Eagle Premier series. I haven't written one of those yet. It has to be on a paper app, but that's a whole life option for when you're looking at people that are under 50 years old, because the Eagle Premier series, the final expense product, goes from 50 to 85. But I plan on writing one of those within the next week or two when that kind of pops up, when that arises. So before I go any further, because this is going to be totally open forum, what would you guys like to see right now? You guys want me to go into some of these e-applications, or do you have some specific questions about how these products work?
Yeah, no on the e-app, just maybe a little bit of the features and benefits. Like, I know there's like a disability rider, there's critical illness, just a little bit about some of that within those three main plans would be helpful.
Cool. Yeah. So the Eagle Premier series, it's like most of our other final expense policies. It does have living benefits tied into it. So basically, if something terminal or something critical were to strike, you'll have access to 100% of those funds. They double due to any type of an accident, and they start to build cash value after, I believe, 2 years. So they're fairly kind of typical to like whole life plans, with just a couple special features here and there. The HMS Plus CBO has 50% tacked onto it for the accidental death and dismemberment. And when you get into mortgage protection, this is I love this feature because, a lot of us are coming from another company that also had a return of premium or a cash back option. So a lot of us are familiar with how that works and love how that works since we work with that other company. So it's really cool. Like if somebody's got a 30-year mortgage term, how you kind of set it up is you say, look, we're going to put you on a 25-year HMS Plus CBO. We're going to put you on a cashback plan after 25 years. That lump sum that you get, that's going to help you pay off your mortgage 5 years early. So you basically, how you position it is you say, you're going to get free insurance with us, or with America for 25 years. And once that insurance runs out, unlike most other term policies where you lose the money or the premiums go up by 10 times the amount, you're actually going to get all your money back. And that's going to help you pay off the mortgage 5 years early. But also another great thing about America when it comes to the mortgage protection plans is, let's just say they've got $250,000 in coverage with us. If something terminal, like cancer were to strike, they're going to have access to the full 250,000. Something critical, like a catastrophic car accident where they're paralyzed or broken neck or something like that, they're going to have access to the full 250,000. Or something chronic like Parkinson's disease or disabling rheumatoid arthritis or something like that, again, they're going to have access to the full 250,000. This is a great benefit to bring up if you're sitting down with small business and self-employed folks, because all of us on here are small business and self-employed. And if you've been in the game for a while, you realize that it's rare that we can have any disability plans cover us. And if they do cover us, I mean, you pretty much have to be like, in a coma for them to start paying out. So this is great. If something catastrophic or something critical were to strike, however large of an amount they have with this, they can use that till they're maybe waiting on their permanent disability through the state, or until they get back on their feet, if they ever get back on their feet. So that's kind of.
Todd, did you say they could use up? Oh, I'm sorry. Did you say they can use up to the full amount on the
Amicable,
term policies?
With Amicable, you can, yeah. So if you've got 250,000 in coverage, if something terminal, critical, or chronic were to strike, you have access to that full 250,000.
Okay, and that's different than the whole life, which is 50. Is that correct?
What do you mean?
50%.
You were breaking up. I'm sorry.
I think he said
Just trying
that
to
he
get a
could.
grasp of this stuff here, but the Eagle Premier, like 50%, up to 50%, they can use if they're critical, chronic, or terminal. But the
I thought it was 100%.
100%.
I thought it was 100% with the Eagle Premier as well. But
it
maybe somebody else can chime in.
Yeah, sorry, I didn't mean to throw a monkey wrench into it. Carry on. I'll dig a little deeper on my end here. No.
If somebody knows the answer to that, please enlighten us for sure. Because it's kind of funny that I'm running this call when I still have to make call typically every day with questions that I still don't have the answers to. So does anybody know the answer to that? Do you have access to 100% of the policy amount with Eagle Premier? If something no, okay,
It's 50%.
Just 50%. Okay, cool.
50%.
Cool. Thank you, guys. So that's
Hey, Todd, real quick, is that 100% true on all three of those term products, the 100, 125, and CBO?
I believe so. That's what I've been told. So I believe that that's how it works. And again, if somebody else has something to chime in on that, this will be an open forum and a learning experience even for me as well. So now I'll stop telling people with Eagle Premier they've got access to 100%. So any other questions on the Amicable policies? Nope. Okay, cool. Let's kind of move on over here to Prosperity. So how I do my final expense, I run Amicable first, I run Prosperity second, I run AM, which is American Amicable third, and then AIG is my last resort if I can't get them covered with anything else. When it comes to mortgage protection, I run Amicable first, I run AM second, and then I run John Hancock third. So I'll kind of dive into some of those here as we get towards the end. Also with Amicable, you get an 8% bonus twice a year. So that's over and above everything else they already pay us. So twice a year, if you sell over $45,000 with Amicable within a 6-month period, they're going to give you an 8% bonus. Prosperity does a 10% bonus every quarter. So, and I haven't, maybe somebody else can chime in on this. I forget what the requirements are on Prosperity for you to be able to turn on that 10% bonus, but I do know it's every quarter. I just don't know what the amount is that you have to reach. So if anybody else knows that, go ahead and chime in on that as well.
I think it's 20,000.
20,000. Gosh, that's easy. Cool. So Prosperity, go to the quote engine. And prime term, from what I've seen with these guys, is crap. So I don't use term for Prosperity at all. And with when it comes to Prosperity, you can do anywhere between 1,500 going all the way up to 35,000. With Amicable, they max out at 30,000. So if you've got somebody that's looking for over 30,000, you can do one of two things. You can stack policies. You can do like 30,000 with Amicable and 10,000 with another company. But if they're looking for 35,000, typically I'll just do Prosperity or AMAM, just because I don't want to have to stack 2 policies just for an extra 5,000. Other people might do it differently, but that's how I roll. So Americo on the final expense goes up to 85, and Prosperity and AIG only go up to age 80. One of the great things about Prosperity, there's quite a few great things about Prosperity. One is their contracting is insane. Like, I had a new agent in my office about 2 weeks ago. He filled out his contracting paperwork in the morning, and by the afternoon, he was already contracted. So it's just nuts how quickly they turn around. So this is extremely beneficial when you're hiring on new agents, because some new agents might get in their mind that they need to wait, 2, 3, 4 weeks until all the carriers come in. And that's just not the case. Prosperity, you can probably write anywhere between 90 to 95% of the people that you sit down with. And I'm going to go through that here in the next minute. And then Transamerica has been having a really fast turnaround as well. So if you've got Prosperity and Transamerica in place, you can write 95% of the people that you sit down with. And here's a couple reasons why. Prosperity, they've got a level, a graded, and a modified plan. So level coverage is their immediate coverage. Okay, so that goes into effect as soon as that first auto withdrawal comes out. Their coverage goes into effect. Graded, I believe how it works, and then we can have somebody chime in on this as well. Graded, I think after a year, pays out 30%. After 2 years, it might pay out 70%. And then I think it goes into full effect after 3 years. And they're modified, I think, is their guaranteed issue. But let me have somebody else chime in on those just to kind of educate all of us on the graded, the modified, if I screwed that up.
I just read that last night. The modified is during the first year, it's 110% of the annual premium. If you pass away in year 2, it's 231% of the annual premium they're paying. But everything else, you were right. Graded, it's 30% and 70% on year 2.
Gotcha. And then it goes into effect after the 3rd year?
Yeah.
Okay. Okay. That's what.
Hey, Todd.
That's what I thought. Yo.
Hey, I just actually wrote one in Missouri for Prosperity, and just to chime in on that, it's 30% the first year, 70% the second year, 75% of the full benefit the 3rd year, and then 100% the 4th year.
Really?
Yeah.
I think it might be different in Tennessee then.
Okay.
Because I don't think it has to go 4 years before it kicks in Tennessee. So
I'll double check.
Take everything that we say, guys, with a grain of salt, because different states have different rules and regulations and stuff. Okay. But we're giving you general stuff here, right? So the application process is pretty simple. You have to go through Amicable. So you want to have all this stuff bookmarked, on your iPad. Okay. And I recommend having cell service on your iPad, not just like a hotspot. And then if you've got the Apple Pencil, that makes it even easier. But have all this stuff bookmarked on your iPad. You should have already signed in before you're getting ready to get out there and rock and roll, so you're not completely stumbling around and completely unprepared when you go on your first appointments. So that is Prosperity. Do y'all have any questions about Prosperity?
No question. It's just nice that we only have to open 3 tabs for Prosperity. It makes it really easy.
Yeah. I don't know if they're.
I'm just kidding.
I'm sure at some point in time they're going to add like Great Western and Aetna and Prosperity and these other things to FFL-Go, but I don't know when that's going to happen. Maybe we need to put a little plug in for Hamadi to take care of that for us. So
hey, I was just going to say, hey Todd, I was just going to say real quick. This is Hamadi.
What's up, dude?
If you go to fflvelocity.com/quote, I've got a little because sometimes FFL Go, because it delivers in a frame, sometimes it doesn't work.
Yeah.
And so if you go to FFL velocity/quote, and I'm going to add more carriers on there, but if you go there and see what's missing, just let me know and I'll add them. So that's ours.
Cool. Well, let's add Aetna, Great Western, and Prosperity if we could.
Send me a Slack.
Okay. All right, y'all. So American Amicable is 3rd on my list with final expense, and then 2nd on my list when it comes to mortgage protection. So the home protector, obviously, that is the mortgage protection type policy. Senior choice is their final expense, so that's anybody over 50 to 85, I believe. And then family choice is anybody that's looking for a whole life policy that's under 50. And I think the family choice goes from like birth until 50, I believe. Some cool feature. Oh, and then easy term is just it's a term policy. Okay. With both of the both the home protector and the easy term, you do have return of premium options. Return of premium is always going to be a premium option, so they're going to be paying more for that option. And something that's kind of cool on AMM, you've got a little bit more flexibility. You've got a little bit more ways to customize it. Okay. So on the home protector, you can actually they'll have access to 25, 50, 75, or 100% of the face value of the policy if something critical were to strike. Whereas with America, you just automatically have 100%. With the home protector with AMM, you've got 4 different levels, and they tack on a charge onto that, on the 25, 50, 75, or 100%. The more you go closer to 100%, the more it's going to cost, but it's not like an extreme amount that they tack on. And then with the easy term, I believe that's the same. You can do the 25, 50, 75, and 100, and then also with the return of premium. So AMM is great. So the one thing that I don't like about AMM all that much is, at least what my experience with them is, they'll come back and need all kinds of extra BS to be able to get the policy in place. So if you don't have an assistant part-time or full-time, it can be a little bit more legwork dealing with those guys. So my assistant spends a good amount of time just on getting the extra BS that AMM needs, because they don't do a lot of the underwriting on the front end. It's more back end stuff. So that's my only qualm with American Amicable. What questions do you guys have about American Amicable?
So when would you use American Amicable over Americo?
They're my third choice with final expense, and then they're my second choice with mortgage protection.
So this is just if someone gets declined health-wise, or wouldn't get approved? Is that what you're saying, Todd?
Yeah. Yep. Exactly. Yeah. So when I say first, second, third, fourth choice, the reason is because they won't get approved with the other options. And a lot of times, since Prosperity is so good about taking and having 3 different levels of coverage, a lot of times, if Prosperity is not going to take them, AMM's not going to take them anyway. So then you automatically pivot over to AIG. So you typically don't have to go through all 4. There's been probably a handful of times where Prosperity hasn't taken them and AMM has, but it's rare. I haven't seen it all too often.
Hey Todd,
Yep.
I have a question.
Far away.
You mentioned Prosperity. Hey,
Yep.
If they don't qualify for the level, does it automatically push you to do either graded or modified?
Yes. Yeah.
Okay.
And what you're going to want to do, if you so let's just say if you're brand new and all you have is Prosperity. So you're not going to be able to kind of run a couple of different numbers. But if you have Prosperity and AIG, if it comes back graded or modified, check with AIG, and if the rates are fairly close, then I would run Prosperity. But if the rates are a lot different, then I would run AIG with a 2-year guaranteed issue.
Okay.
Any other questions, y'all, about American Amicable?
What are the situations where you would do easy term over the home protector or vice versa?
Great question.
So I don't really know that one. We got Tim Belo on here. He's kind of an American Amicable pro. They almost seem like the exact same product, don't they? So Tim, do you have an answer to that, buddy?
Yeah, they are pretty similar. The only difference is on home protector. at the bottom, if there's a spouse, you can add a level term onto it, which, tends to be just a touch cheaper, putting the husband on and then putting the spouse on a level term of the same amount. I think you can go up to 200,000 on that level term, but all in all, the prices are pretty much the same. Now I will say this on the critical care, if somebody has a $200,000 policy, the most that they can get on critical care is $100,000. So if they got a $200,000 policy, they can only get 50% of critical care. So it doesn't matter what face value it is. The most they can ever get is 100,000. So
that's on both products, Tim? I'm sorry.
Yes,
is that on
that's
both
on
products?
both.
Okay, great. Thank you.
And also another, I'm glad that Tim chimed in. Another cool feature about American Amicable. So let's just say if you've got a 30-year mortgage protection with Americo, you can't actually get any cash value out of it until the 27th year. So it's 3 years before it hits that return of premium. With American Amicable, and Tim, correct me if I'm wrong, I think it's after 2 years, starts building cash value, kind of like with whole life. And if you need to cancel it or cash it out, you can do that after 2 years, I believe, with the Home Protector return of premium and the Easy Term return of premium. Is that correct, Tim?
Yeah, it works identical to a whole life policy. So if somebody comes in and they want to, if they got a 30-year policy and they look at it and, their situation's changed, and at 20 years, if they want to stop it and basically cash it out, they can do that. So it builds identical to a whole life policy.
So kind of a cool thing. So like, let's just say you've got a client that's got a 30-year term, but they're like, look, I'm going to try to pay this bad boy off in 15 years. It might make more sense to put them on an American Amicable. We don't get, you won't get any chargebacks. And then also with these types of policies, you don't get any residual income anyway. So put them in a better spot and say, hey, look, I'm going to put you with American Amicable, because if you do pay off your house 15 years instead of 30, and you want to cancel this policy, you can and get money back from it. Or of course you can ride it the whole 25 years if you want to as well.
Hey Todd, I had a question.
Far away.
Do you still, so I did for Family Choice, I know you a lot of times have to do an interview. Do you just have to do an interview with the mortgage protection?
I've never done an interview with Family Choice. That might be a different state feature there.
Okay. Yeah, I'm in Pennsylvania, so maybe that's what it is.
Yeah. They're a little backwards up there.
Yep.
I'm from You're Kentucky. In Tennessee.
And I'm from Kentucky, so I can say all this stuff.
Hey, last question on that cash value, Tim or Todd. Do you guys, is there any type of, chart or percentage or amortization type situation that we could look at just to have some sort of idea, like after 5 years, it's 5%, 10 years, it's, you know what I'm saying? I feel like we had that back in the day.
Yeah, I'm not for sure on that, Tim.
There is when you're going through there, when you're putting in the numbers, on whatever product it is, you'll see the 3 tabs down below, view down, it'll say view downloaded something. You click on that and that breaks it down. And it breaks it down to the point where it's going to show you everything on there. But it also on the second page below that, if they've chosen critical care, it's going to show, at 50% and they've got $100,000 policy, it's going to break it down 50,000 for heart, cancer. I mean, it lists the 8 things there. So it's
great.
It looks great.
Thanks.
Hey, also y'all, AIG, which I think I saw Corey on here. So this is his fave. So I got to go over this for him. AIG with quotes. When you tap on the quotes, you're going to get this sheet, right? So these numbers are not going to be correct. At least for what I found in Tennessee, it's usually about $5 off or so. So if you do quote them from this, just, what I kind of throw in just to kind of not look like an idiot, or at least when I first started, is I was like, well, they added on a policy fee. So that's how I came up with this is a different quote. But the quoting tool with AIG, I mean, the quote and the application super easy because AIG takes everybody. You got terminal cancer, we'll take you. Congestive heart failure, we'll take you. had a stroke, last week, we'll take you. The reason why is because they're a guaranteed issue policy. So you don't get anything from these guys within the first 2 years, but how you paint a prettier picture to when you're sitting down with clients is you say, look, these are the only guys that are going to take you. Within your first 2 years, if you pass away from an accident, it's going to pay out the full amount. Okay. Once you get past those 2 years, it's going to pay out double the amount of the face value of the policy. And then once you hit 2 years and 1 day, it's going to pay out 100% of the policy due to natural causes. Now, if God forbid, if you were to pass away, not from an accident, but natural causes within the first 2 years, you're going to get 100% of the premiums back, or your beneficiary will get 100% of the premiums back plus 10% added on top of that. So it's like the best savings account that you can have. So I really try to paint a pretty picture for them because, as you guys know, getting anything in place for our clients is better than nothing. So you don't want to paint this in a negative light, because if they're 60, 70, 80 years old, I mean, they've already been procrastinating 60, 70 years to get a policy anyway. So, I mean, this is going to be the best option for them. And it's super, super simple. They don't ask any health questions because they take everybody and all that good stuff.
Todd, when do they usually pay out for AIG? Is it a certain day of the week that you have to get it in before they pay?
You know what? I don't even know, man. I don't think AIG's paid me in months, because a lot of times when you're writing AIG, you're dealing more with lower income. You're dealing with people that have Direct Express. And just a little side note, what Direct Express is, it's a debit card for low income folks that don't actually have a real bank, real checking account, or real savings account. There's only 3 carriers that do Direct Express. Prosperity is one of them, AIG, and then Transamerica. So when you're writing lower income folks or super unhealthy folks, with AIG, so I've had some chargebacks with these guys just because it's not the strongest business that you can write. So in most cases, any other.
I actually had to call them the other day because I hadn't been paid for one of mine, and it's very strange. It's like any business that's submitted on Wednesday, their week runs Thursday to Wednesday, and it's in by like 3:00 on Wednesday. It gets processed by Friday, and then you get paid the following week. So if you write a policy on a Thursday, you may not see anything for like 2 weeks.
Gotcha. Wow. And also they pay the lowest amount. They pay basically they pay about the same rates as what we were making with the other company. If you work with the other company, which is kind of funny because we used to think that was a lot of money. And now when we write AIG policies, crap, we're only getting paid the same amount that we got paid from the other company. This is horrible. But they also I think only advance 60%, I believe, instead of 75% like the other carriers as well. Okay. So any other questions? Go ahead.
Yeah, I just had a comment. You got to look at Great Western. I just wrote 2 on Great Western, and they do have a guaranteed issue product, and it's pretty easy. So you might want to check them out. I don't know if you've gotten in contact with them, but check them out.
Just a heads up with that though, they pay you even less than AIG.
Oh, so they do.
Yeah. So Great Western is like absolute last resort. Like if you're trying to stack 2 guaranteed issue, you want to do AIG and then Great Western. And then somebody might be able to chime in on this. Does Great Western do guaranteed issue between 81 and 85? Does anybody know that? Anyone? No? Okay. I don't know if they do or not, but that would be a good option as well.
Hey, Todd.
Yeah.
Sorry, this is Corey. Keep in mind, guys, make sure you do your homework on Great Western before you go into a home. I think Great Western is only in 9 states.
Yeah, it's a good point. So they're not in Missouri, y'all. So that won't even factor in. What was I going to say? I can't remember. Cool. Any other questions about AIG, y'all? Nope. Cool. So John Hancock, so this is your 3rd pivot when it comes to mortgage protection. At least it is for me. So I do Americo, I do American Amicable, and then I do John Hancock. John Hancock, you can go all the way up to $500,000 without having a medical exam. So it's freaking amazing. But some limitations to it is you have to be 60 years and younger. They do have a return of premium. I don't know. I've heard different things, so maybe somebody can chime in on this as well. Does anybody know about any living benefits with John Hancock's return of premium simple term? Do they have them? Don't know. Okay.
Like modern like features, like you get special discounts with Amazon Prime and like stuff like that, not like true living benefits.
Yeah. So another cool thing about John Hancock, if you're sitting down with younger folks, you get the newest version of an Apple Watch when you sign up for their Vitality program, which you'll have access to at the end. So if you sign a husband and wife up, they're both going to get brand new Apple Watches, which they can use, or they can, obviously sell them on eBay if they want to. But then their return of premium was a little funky, but it's better than not having return of premium. They give you back 75% of their return of premium over the life of the policy. At least that's the way that I read it and I understand it. So it's almost like they give you a rebate every year leading up to the term of the policy, but they only give you a 75% on the return of premium. And also an American Amicable, it's 75% return of premium as well. Whereas America, you've got 100% return of premium. And I believe that's right. So if anybody else is fact checking me, make sure that that's correct. So I'm telling everybody the right stuff.
Did you say each year, Todd?
With John Hancock, I clicked on like their question mark about the return of premium the other day. And that's the way that I read it. I could have read it wrong. But yeah, I believe with their return of premium, they almost give you back like a rebate or a discount each year. And they consider that to be return of premium. And they only do it up to 75%. I believe. Don't quote me on that. That's what I read. And also, guys, John Hancock does a couple different things. How they prefer to do it is they want to sync up with people's bank accounts. So some people are a little bit leery about that because they literally put in their password and stuff like that. Just try not to make a big deal out of it, and try to talk about how, we only work with the best of the best companies, A ratings. They've all been around most of them have been around for over 100 years. So their securities like Fort Knox, all that jazz. But a couple of different things you can do with John Hancock. You can also do a credit card. But then down at the bottom, you can also punch in banking information as well, like a routing number and an account number and stuff. But I also will say, you cannot post date with John Hancock. Okay, so I'll say that again. You cannot post date with John Hancock. So when you click to submit, it's going to go through like that day or the next day. So it goes through really quick. But again, you want to focus on the positive and say, hey guys, one of the great things about John Hancock, the reason why we work with these guys is because their turnaround is so fast. We could get you covered probably today or tomorrow with these guys, which is awesome. If you make it past the underwriting, of course. Any questions about John Hancock?
These guys, it's just term you're using with these guys?
Simple term. Yep.
Okay.
Yeah. So I pivot over to that if they can't get either one of the mortgage protections. Now, guys, I'm not contracted with Moo. So I think some people will also pivot over to Moo, which is Mutual of Omaha, if they can't do Americo and if they can't do American Amicable with mortgage protection. So maybe somebody else can chime in about that. No? Okay.
I know the product really well. Can you hear me?
Yep.
Yeah, I know the Moon product really, really well. And I know virtually all the guidelines. The Moon products are the very, very amazing products. For instance, where America offer the HMS CBO, which is basically the mortgage protection product with the cashback offer.
Yep.
Moon actually has, they have the term products with the cashback offer as well. But the difference with the Moo product, that is, they have at the end of the term, they have a reduced paid up options. So let's just say that if you were to do the Americo and you end up having $40,000 hypothetically at the end of the term, whereas at the end of that options with the Americo products, it will be the end of the story. You get your money and just move on, and you no longer have any coverage. With the Moo option, let's say you choose, instead of getting your $30,000, I just want to get 15,000. I'm gonna leave $15,000 back in there as a reduced paid up option, which will be my life insurance till the day I die. I no longer have to make another payment. Yeah.
Oh, that's cool. That's awesome.
It's amazing.
Yeah,
it's amazing.
That's super cool.
Because I get all the money up front, and I can leave it all in there if I wanted to. There's a reduced paid up option. There's a factor that can be calculated, but that's a lot more complex to get into it. There's a factor that can be calculated, but let's just say, to simplify the issue, let's say I have $40,000. I want to take 20 with me. I want to leave maybe 15 to do a final expense, and I'll die with it.
That's cool.
Another option, basically, that the MUA also has when you do the IUL Express, which is a simplified issue, that is the ability to have a cash built up. If you're dealing with a client whose intent, he wants to do a whole life, they want to do a whole life, for 200,000, 300,000, you know it's going to cost them. By the way, the max 300,000 is up to age 50. When it raises above age 50, it decreases to 250. Just so you know, 51 to 60, decreases to 250. But let's just say that a client wants to do a whole life for 250. The really intent of doing that, you know damn well it's going to cost them an arm and a leg. Whole life costs a lot of money. What you can do, you can pivot to the IUL Express, where you want to do the Express because it's a simplified issue. It's not complicated. There's another product. There's another way to go about it with the income advantage with Mutual of Omaha, but it's another complication here. Let's not get into that. Let's keep it simple. Simplified issue Express. You can pivot to that product, but here's the beauty of that product. The beauty of that product, because it's indexed, you basically give your client the price of a term product for a whole life, because the product is actually rated for 65 years. They're designed to keep the product for 65 years until they're up to age 120, which they never will reach. So it is a beautiful product. If someone wants whole life, but they don't want to pay the price of whole life, you can pivot to IUL Express, which is way cheaper. I did all the comparison prices, way cheaper. You can get them in here, and they have built-in cash value. They can surrender the policy at any given point, and there's a lot of benefit to the policy. It has built-in chronic, built-in terminal, built-in the 3C, CCT. You know, it's all that is built in at no additional cost. If they need long-term care, you can you can retrieve some of the money out of the policy, some of the cash value if they need long-term care. Guess what? If they become unemployed, you can retrieve some of the money from the policy.
Wow.
Guess what? If
I want to sign up for that policy.
If something, it is called an IUL, and then Universal Life Express. Now, here's something interesting. Let's say they have a major flood to the primary residence. It has to be a primary residence. They can withdraw money out of the policy, and waive the surrender value, waive the surrender fees. It's an amazing policy. It is an amazing policy. Awesome. And it's an amazing substitute to what America will offer. And it's way cheaper than America. Way cheaper than America.
Let me put it. Go ahead. No, go ahead.
However, watching Mutual of Omaha, they're not the people designed for anybody who has a lot of problems. I'll tell you that. If you have somebody who has issues, you can go there. Yeah. You cannot go there.
And that's
premium.
Good.
It's a premium to premium. Now, there's one more. They have one more. I would say one more thing that you want to know as well. On the fully underwritten products, which would be any policy like Income Advantage policy, or what they call the Term Life Answers, which is different than Term Life Express, which is a simplified issue. The Term Life Answers, which is $100,000 up to $10 million, no issue. On those, there's a special clause. They can give you an accelerated underwriting if you have an EM1 up to $5 million. Here's what it means. Wow. It means crazy. You're not going to get a medical underwriting. You're just going to get a phone call, phone interview. So you can underwrite, virtually table underwrite, because you just make a phone call up to $5 million.
It's crazy.
It's amazing. It's amazing. So that's for Mutual of Omaha.
Well, thank you for that, because I'm still not contracted with those guys, so I am completely in the dark when it comes to Mutual of Omaha. But just to kind of reiterate what Richard said, when it comes to term policies and when it comes to IULs and stuff as well, you've got to be relatively healthy. So if somebody's looking for $100,000 in whole life, but they had a stroke within the past 3 years, or they had cancer within the past 5 years, whatever it is, then final expense is probably going to be their only option. You're not going to be able to go with, like a large amount with whole life, and you're not going to be able to go with an IUL because they have to be relatively healthy to be able to. And then same with mortgage protection. You got to be relatively healthy on that stuff as well. So any questions?
Can I just
clarify?
Yeah, I just want to clarify what Richard just said.
Yeah.
With Mutual of Omaha, healthy person, you can get a policy up to $5 million, and the additional underwriting from other products that we sell is simply a phone call. Is that what I heard?
I think so. Yeah. So with others to go up to that amount, it has to be fully medically underwritten. And if
yes,
Richard Wright,
yes,
then you can.
Yes, absolutely.
Yeah.
It's called an accelerated underwriting. It's basically a special provision with a fully underwriting product. It's a special provision, which means up to $5 million. You really have to be super healthy. You have to be super healthy. Instead of actually giving the full medical exam and all things, basically they'll bypass that and just basically have a phone interview.
That's super cool, man. I can't wait to, it's been 5 months, so I can't wait to get finally appointed with those guys. I think it'll be another month or two before that actually goes through, but that'll be the day. They've lost a lot of my business, but so that's great. Thank you so much for chiming in on that, since I'm completely in the dark on those guys. Now there's a couple. Yep.
Hey man, this is Jerry. So I wanted to share.
I wanted to add one more thing to the Mutual of Omaha.
Moo.
Wait 1 second, y'all. Jerry, go ahead.
No, to a good point. I do write a lot of Moo, but also I write a lot of big policies through them as well. IULs are a lot of term. The accelerated underwriting is great. There's a very good likelihood, especially what I've seen with COVID, even people that are going to get preferred plus, they're going to want them to end up getting blood work done. So they do go through getting the medical questionnaire, basically telephone interview completed. But I would set the expectation with clients, even if they are super healthy, checking in with their doctor with the COVID circumstances, there's still good likelihood they're going to have to get blood work. So if you run into a situation like that, I'm just saying. But I think in comparison, if you're talking mortgage protection, this is important to know a difference between Moo and Amicable. Yeah. The Moo products on the living benefits, you're only looking at chronic and terminal living benefit, no critical in some of their products. And that's important because if you know the difference between chronic and critical is going to be like those 9 specified type of situations, heart attacks, Parkinson's, I think is in there, strokes. Those are super important because if you're saying, hey, your mortgage protection, maybe you're in your 40s, husband and wife, working, active, one of those things come up, that may not be a chronic condition, how they define as far as progressing and staying with you. And so if you're comparing Amicable and Moo and building the value, that could be very valuable for them and maybe worth to them paying a higher price than the Moo policy. Yeah.
So guys, Jerry writes probably more anybody else. Wait a second. Jerry writes probably more than anybody else in Velocity when it comes to IULs and when it comes to larger policies and stuff. He used to work with New York Life, so he is the go-to when it comes to those different types of policies. Richard, what were you gonna say?
No, Jerry, with all due respect, I don't know the last time you looked at the underwriting guidelines. They do all 3, critical, chronic, and terminal. And I've spent quite a bit of time with the account executive, Joshua. I can tell you for a fact, they do offer all 3. So I'm not sure.
That's why I said on some of the products. I said on some of the products.
Because on all the term products, IUL, they do offer. They do not offer on the living promise. They do not. It's only accelerated terminal death. But on the IUL, they do offer. On all the term product that IUL offer.
Somebody else had something that they want to chime in on.
Todd.
Yeah,
Mutual of Omaha actually sent emails a reminder about the payment, so that's also a good way to keep your policy in the books.
Nice. They got a lot of special features that I haven't been able to access yet, so that's pretty sweet. So, guys, also there was some ancillary carriers that we work with. Transamerica is good because they've got some special features. I try not to use them just because they're a pain in the arse, but they are a lot friendlier when it comes to COPD. And then they've also got a couple of different options. Of course, all these carriers have stupid different names, for their products, which doesn't make any sense. But Immediate Solution, that is the one that goes into place immediately. So that's nice. Easy Solution, I believe, is their graded policy. And then 10 Pay Solution, that means that they can actually pay up this policy in 10 years. So it's going to cost more, of course. But if somebody wants a paid up policy, Transamerica is the way to go. And then also you can do kind of a neat thing when you're plugging into to Transamerica. If you're looking at like somebody younger, or if you're looking at somebody that's looking for like some special features, I'm not going to go through all that, but it'll tell you what policies you can write with them. Once you punch in their basic information, it's going to say, okay, this person can apply for this benefit, or this person can apply for this benefit. So I've written a couple of Transamerica policies for people that are under 50 that can't get a final expense. I've kind of pivoted over to Transamerica to go with those guys. Royal Neighbors. I think I heard somebody chime in on the Slack page here a little bit ago. Royal Neighbors is great when it comes to no build chart. So you're sitting down with somebody from My 600 Pound Life, go with Royal Neighbors. Also, they got some special features when it comes to some of their whole life policies. So if you're looking at somebody that's under 50 and maybe they're looking for like 100,000 in whole life, I've found Royal Neighbors is a pretty good option to be able to give them some quotes through that as well. So, and then Foresters is man, their final expense is a pain in the butt because you have to go through a phone interview with them. So I try not to use them. They do have some pretty good rates. Their back end office has been a little bit of a pain in the butt to work with and stuff, but they do have some special features and some good benefits. So like since I don't have Moo, I've written all my my universal life policies through Foresters because that's the only real option that I have with those guys. So any questions about Foresters, Transamerica, or Royal Neighbors?
So you're just going to these if you're declined from all the other ones?
Foresters, if somebody's doing price shopping, a lot of time I'll go to Foresters because they're typically going to be one of the more affordable. Since I don't have Moo, so like if they're looking for kind of like what somebody chimed in on, if they're looking for 100,000 in whole life, but it's going to price them way out of the market, then you're going to want to go with the universal life, because another cool feature about universal life, and Jerry taught me this, is you've got like a flexible premium amount that you can pay into it. So there's going to be like a target range that means that policy is going to last probably until they're like 100 years old. Then you're going to have, like, if they pay below the target range of premium, then it might last like 10, 15 years or something along those lines. And then if they pay over and above, I think that'll run them all the way to the 120-year mark. But Jerry can probably speak at a little higher level than I can on those three levels. Is that about right, Jerry?
Yeah, Todd, you're right. As long as they pay the target, it's projected to stay with them. If they pay above that, it's really going to feed more into cash value end of it, but then preserve it for a longer time. Also on the Smart UL, what's nice on the living benefits, it's 95% of the face value for their living benefit, as opposed to maybe like Moo, I think it's like 80% or some of the other carriers.
So at Foresters then.
Correct. Foresters is 95% living benefit.
So guys, that's a cool. That's a cool feature, y'all. And I didn't know that. Yeah, so with the target amount that they tell you on the universal life, then it's kind of like Jerry was saying, probably going to last them their whole life. If they pay over and above that target amount, then it's going to build up more cash value that they'll have in the policy. And then, of course, if they pay less than the target amount that they tell you, then it's not going to last very long. It's probably not going to last their whole life. But people can pivot back and forth if they hit a rough patch in their finances and they need to pivot down to paying in less into the policy for maybe 3 months, 6 months, or even a year, they can pick it back up again and start paying in more to make that policy kick back in again and last a little bit longer than cutting off short and stuff. So that's a cool feature about universal life policies.
But premiums will never go up in terms of like if you lock it in at a certain rate, their premiums wouldn't go up by the company. They could just have the option of paying more or less. Is that what you're saying?
I believe so. Jerry, is that correct?
Right. What you'll see is, especially on Forrester's, their quoting tool, I like the way they do it. And you'll see probably the only one from them, they will actually tell you, here's the minimum payment, what they call the smart UL premium. And then they will show you like the max. And so they have to set that one. The minimum is just saying, hey, the least you could pay without necessarily lapsing the policy. So just like Todd mentioned, if they come up, let's say it's the holidays, right? Christmas, they're like, man, I don't want to pay that $200 payment. Can I pay $50? That could be a realistic option. Then increase it back to their target premium after that 1 month. But if they overfund it or pay in more, right? They're already covering the cost of the insurance. It's just the rest is going to go into the cash value side.
So, and just to kind of be respectful, of everybody's time. Go ahead if you had a question for Jerry.
Yeah, I was just going to see if Jerry wouldn't mind, taking 60 seconds or whatever it might be.
Yeah, go for it.
Just a quick overview on UL in general.
Yeah, that would be awesome. Jerry,
because I feel like we're getting into the weeds on some details without maybe some context. So that would be super helpful if you wouldn't mind.
Yeah, for sure, Jerry.
I'll say this because it will put some context around it and maybe why it's like, well, sometimes why is a universal life policy less expensive than a whole life for the same amount of coverage? And it's just the way that they create these plans. So a whole life insurance plan, the cost of insurance is built in, it's level, it's never going to increase. You're talking about the cost of insurance. On a universal life coverage, what the insurance company basically doing, it's almost like the cost of the insurance is a yearly renewable term. And so they intentionally start the cost of the insurance very low. As you pay into it, what they're expecting to do is take your premium, credit interest or earn interest on it. That's going to help offset some of the cost for the insurance itself. So most people don't know that in terms of the difference between those whole lives and ULs. The cost of insurance is not level on both of them. The universal life is going to start low. Each year it actually increases and goes up, but it's beneficial for the client because they're probably going to be able to leverage more coverage for less dollars with the anticipation that the insurance company is going to get a higher interest on their end, be able to help offset some of those costs over time. And that's why it gives them flexibility on the premium, because as they're earning that interest, let's say the insurance company starts earning 6, 8, 10%, they only expect it to earn 3 to 4. They're not going to keep that. Some of it they're going to credit to that plan. So they may actually cover more of the expense for the client.
And that interest that the client may be earning or that might be going towards that, is there any guarantees? Could the client lose money?
No, most of the plans now you'll see there's actually a guarantee, like the Forrester's UL has a guaranteed 2%, but the current crediting rate, I believe, is 4.3. So clients may like that when they know, okay, this is a universal life. That's the difference between that and an index universal life. The interest is variable based on what the index is going to do.
And we can't write those, can we, Jerry? Because we're not licensed to do that, right?
No, you can. You can do the index universal. That's with MU and then Global Atlantic. So it's not tied to the stock market. You're just participating with the market.
I'm thinking about variable annuities, I believe, what we can't do. So yeah, this is a little bit above my pay grade. So that's why thank you, Jerry, for joining this.
I'll tell you this, guys. So you don't, Hamani and I have been talking about that. We're going to put some training together that's a little bit deeper on IULs and
yes, please.
index annuities too. So
please, right. For sure. But
go ahead, Todd.
Let's get that rocking and rolling sooner or later. So guys, Aetna is great for when you're meeting with clients that are 86 to 89 years old. So they're actually the only carrier that we have access to that'll be able to write between 86 to 89 years old. They've also got some different levels of coverage, which is nice too. So, I mean, if you're not sitting down with the healthiest 86 or 89-year-old or 88-year-old or whatever, they'll give you some different types of levels, which obviously will come into the premium and make the premium more, the more unhealthy they are. And then, they can, of course, shoot them down. I haven't had any denied with Aetna as of yet, but I've only written like maybe 5 policies with them. I sat down with an 88-year-old who was super healthy, and she wanted like 15,000 coverage. It was like $300 a month. And she's like, oh yeah, that's great. I'll take it. She was a little bit more well-to-do than maybe some of our other clients. So guys, so just to kind of be respectful of everybody's time, we've got 2 minutes left. And then of course, if we go over, anybody can clock out if they want to, but any other questions pertaining to anything that we said, and especially if you got any questions for Jerry, because he is the IUL, the UL, and probably I'd say even the annuity master on the call. So.
In general, in what situation would somebody go to a UL versus term versus whole life? Like, what type of person would typically be requesting something like that?
I'll leave that to Jerry. Jerry, you still there, bud?
Yeah, I'm here. No, we talked about this too, Todd. I think when it comes to that is amount of coverage is going to determine that. One, if you're looking at final expense, right, kind of limited there. And so UL is going to give you that ability to go higher. Second thing is when you're looking at value in terms of their premium, sometimes you may stack those final expense policies and this person is healthy. But the premium, when you put all those plans together, let's say to get to 100,000, it really is just going to push them either budget wise, or they may know, especially if they are truly shopping, that, hey, I could probably go out and find a plan. That's where the UL may come in and be competitive in terms of price.
But they generally have to be healthier to be approved for that though, right?
Not necessarily.
Sorry.
I was going to say because I found, especially I think with things like the Forster's UL is actually positioned. I've seen with like diabetics where they're willing, it's probably going to go to underwriting, but that's not always a bad thing, especially if you're dealing with someone with some impaired risk, because you can offer some commentary back and forth with the underwriter. And so that may be a chance for you to paint the picture a little bit better than just the application.
Now, Jerry, you talking about pills or insulin when it comes to diabetes?
Talking about both, because I think what their biggest concern is more the complications,
gotcha.
Okay. Stuff like that. Yep.
Okay, cool. Awesome, y'all. Well, it's 9:01. Do y'all have any additional questions for us about anything that we have covered?
Todd, I just want to acknowledge you, man, like for putting this training on. You've sold a lot of insurance, and it's funny for me to think that like 3 months ago, you didn't even know what the difference was between, any of these kind of things. So like to see how quickly you accumulate the knowledge, and it's all, from the street, which is really cool. And I think for most of the people on this call, like, I can tell some of the listeners are like, ooh, that's, how do I understand the difference there, et cetera. The best way to learn this stuff is in front of clients, and you get in front of a client, you have a situation you don't know how to address or how to close. And it's like, you pick up the phone and call somebody, even if you have to schedule a comeback or whatever, because that's the best way to learn, instead of having all these hypotheticals, deal with real world examples. So anyways, appreciate you, Jerry. Thank you, Richard, for chiming in. That's incredible when you think like Richard just started selling insurance. All the knowledge that he just spouted was literally from being on the phone with, and that's another thing, by the way, is get on the phone with these carriers. If you don't understand their products, they have a sales desk that's just designed to do nothing but help you sell their products. So they're going to tell you all the good stuff that you want to know, and that's free training. So anyway, thank you guys.
Awesome. And
hey, Todd, I got a couple questions for you.
Yeah, fire away.
Because I think some you touched on yesterday, some personally I'm going through, but then also seeing agents, bringing and onboarding agents. We talk about, hey, start with final expense, maybe is the easiest place, simplistic sell. And then, but, I've also seen either within our office or other agencies, mortgage protection work in that market just seems to bring up higher premiums, right? You talked about that yesterday with making a shift, mortgage protection side. I guess I have a question and it's probably more mindset. When I think, especially being a dad, having all kinds of other things going on, I think mortgage protection, I'm like, man, evenings and weekends, right? So tell me, one, is that probably that perception is wrong, but activity wise, how much of a blend are you still running final expense, mortgage protection any given week? And how many of those appointments are you what does that start, finish day, weekends look like?
Yeah, that's a great question. So I think I waited too long before I made my switch over to mortgage protection. When I say switch, like I just started running half to maybe even a little bit more than half on the mortgage protection side. So when I've listened to, I think every single podcast that Family First Life has put out. So I also want to plug that as well. Guys, if you're not being a student of the game, if you're not taking this serious, and if you're not educating yourself and trying to learn from people that are a lot better than you, then you're missing the mark. I mean, I listen to podcasts like 24/7 in my car, when I'm taking a shower in the morning, like I'm constantly educating myself. And what I've found with listening to a lot of these podcasts, for all the people that do 100,000 plus in a month, and there's probably about 5 of them that have accomplished that, maybe 10 or less, but all of them do 75% to 100% mortgage protection. So now, yes, Jerry is correct. Obviously, if you're dealing more with middle class to upper middle class with final expense, you're dealing more of middle class to lower middle class. So you're typically going to have the breadwinner working, from 8 to 5, or you're going to have both of them, working from 8 to 5. So you're going to have to run more weekends, or you're going to have to run more evenings. But the deal is, like, when I had, I didn't have that many appointments. I think I sold 9 families last week for $23,000. I think I had 23 appointments, but and I think only like maybe 15 of them came through or something like that. I was doing the numbers for somebody the other day, but you're going to notice that you're not going to need as many appointments. So you're not going to have to run as hard when you're doing mortgage protection, because, I mean, it's like I've sold, $300 a month, $400 a month with mortgage protection. And then a lot of times when you're doing both spouses, you're doing like $200 or $300 or $400 a month as well. So yes, you do typically have to run in the evenings and have to run some on the weekends and stuff, but you don't have to run as many appointments because the premiums are much higher.
Hey, Todd, you were talking about the leads that you were purchasing and how Game Time is really good for mortgage protection. What other ones are you using for mortgage protection, also for final expense?
Well, I've got some bad news. I've got some bad news for y'all. Game Time, unfortunately, has shut down their mortgage protection leads because they were losing money on it. So I've literally been in direct contact with them, begging them to bring it back. So potentially they might bring it back after the beginning of this new year, and you better believe that I'm going to be the first one that's on the phone with them trying to get them to bring it back, because mail out mortgage protection leads are $81 a pop. Game Time, which I've had more success than any of the other mortgage protection leads, are $55 a piece. So they're more affordable. And I would buy with those guys 15 on Monday, and I'd buy 15 on Tuesday, or 15 on Monday, 15 on Thursday, and then supplement it with, instant internet leads and some other things. So what I've pivoted over to since Game Time is done is I've been buying every single age mortgage protection lead that I can. Okay, guys, this is a huge missed opportunity. The past 3 policies that I've sold, I've sold over 10,000 and I've spent $9 on those leads. So calculate that ROI. That's huge. $9 on age mortgage protection leads and made over 10,000 on those 3 past sales. So buy those up. I had a little bit of a negative experience on the front end when I first started. I was like, oh, these things are bunk. Just like all of us new people, we want to blame, the leads, but the leads are leads, right? So, and if you buy enough of them, if you work enough of them, you're going to be successful. It doesn't matter what type of lead it is. But that's primarily what I've been doing is the mail-in leads. I also do call-in leads, which you can go through the home office to get access to those as well. That's where people either call in and give the information, or they hang up and they don't completely complete the phone in information, and then the age mortgage protection. So those are the 3 different places that I pull those from right now.
Hey Todd, I have a question on the age mortgage protection. Let's just say you buy, hypothetically, you buy 100. How many of those you schedule on the age one?
A lot, for a couple reasons. One, I feel like my skill level is higher than the other people that are actually paying full price for them. So I know I'm going to be able to come up behind them and close them. But just speaking from a personal standpoint, I know that I can't get to all, like I've got a surplus of leads right now. Just for whatever reason, I just have a crap ton of leads. So I'm not going to be able to get to all the leads. I'm going to try, but there's other people that maybe can't get a hold of them because they're on vacation for a couple weeks, or just because they're lazy, or because they quit, or whatever it might be. So you're going to find a ton of diamonds in the rough when you get those age mortgage protection for all those reasons that I just mentioned.
Thank you.
Yep. And then I think we had a question from Chris. Chris, you said send those leads to me. You can get those leads in our CRM. So once we give you access to the CRM, you'll have access to instant internet leads. You'll have access to aged mortgage protection leads. Then you also have access to internet leads and then final expense leads as well. So anything else, y'all?
Todd, can you post? Yeah, can you post the script that you're using for those aged mortgage protection leads?
Yes, I will. I will post my Google Drive, which gives you all access to my in-home docs, all the scripts that I've accumulated, recruiting stuff that I've stolen from Hamadi, and basically anything and everything that you'll probably need. And if you don't see it in that Google Drive, then let me know and we'll add it to that Google Drive, because I've kind of been putting together a little bit of a library with all important stuff. Now, if you're new, maybe don't get too much into the weeds with that. But if you've been running for a couple weeks, there's going to be some things in there that's going to be a little bit over and above from some other sources. So I'll put that on Slack in the general right when we hang up. Okay.
Hey, Todd, I got a couple other questions. One, do you make all your own dials, or are you using a dialer at all?
I am using a dialer now, just because recruiting has gone up tremendously. I see a lot of new faces on here that have recently signed up with us, which is awesome. So I was doing all my own dials for probably the first 3.5 months, and then I started. There's a young lady that works with us that hasn't been able to get a lot of her contracts in yet, so she's been helping out with my dials. And then I've got an assistant that started off part-time. Now she's full-time, and she probably does actually most of my dials now, to be honest with you, just because I've got so many other things. And it's probably time management issues that I have, but whatever. But she does most of my dials for me now. So.
No, not time. I call it delegation. I think people always ask that question. How do you produce and recruit at a high level? It's like delegation, right? I mean, hire someone to do that. But hey, question about this too, because I know a few months back we had a business coach opportunity where people, I think Hamadi brought on. Are you using a business coach, or how are you helping have your own personal accountability to perform at a high level?
I am. I'm using Southwestern Consulting. Good friend of ours who was with the other company, Dan Lahane, spoke highly of those guys here a couple years ago, but just didn't really fit into my budget. And I know, hey, what you invest, what you get back, blah, blah, blah. But, making 2, 3, 4 times more over here. So it definitely fits into my budget now. I have found that's great, helping me think outside the box, help me to strengthen my weaknesses, because I mean, I've been in the game for long enough. I know what my weaknesses are on kind of both sides of the fence. So I would highly recommend Southwestern Consulting, and I can put you in contact with someone over there as well. Any other questions, y'all? Good stuff.
Thanks, man. Really appreciate all of you guys.
No, thank you, dude. This was your idea, bro. So thanks for bringing up the idea, man. All right,
Yeah,
guys. I'm gonna.
Thanks, guys. Great information. Thanks a lot.
Yeah, I'm gonna post that that Google Drive on the general Slack page. You'll probably need to request access from me, but I'll give access to anybody and everybody. And you're more than welcome to share that with any people that are on your team and stuff as well. Okay.
Hey, Todd.
Yo.
Anybody ever told you kind of look like John Favreau with a mustache?
Yes, especially the skinnier version. You know, not that he's like that he's eaten another person the size of me, but yes, from the Swingers Day, yes, I've heard that before.
Yeah, nice, exactly.
So cool. Anything
Thanks,
else, guys and gals? All right, let's crush it, and I will post that Google Drive on Slack right meow.
Thanks, guys.
Peace.
Thanks, everybody.
Thank you.
Thank you.